Big changes may be coming to the mortgage industry, and it may make homes more affordable for you. We'll get into it. This is The Will Whiten Show. So today, our top story is about the 50-year mortgage that is being floated about. There's an article from CNBC that gives us some of the details. It says Trump proposes a 50-year mortgage, but some say homeowner savings would be minimal. As we know now, the largest typical mortgage that you can get goes for 30 years. So this would extend that for 20 more years. It says in another attempt to make home buying more affordable, President Donald Trump floated the idea of a 50-year mortgage on social media post. The Federal Housing Finance Agency Director, Bill Pulte, who oversees Fannie Mae and Freddie Mac, posted that they are, quote unquote, working on it, and it would be, quote, a complete game changer. So it looks like something that is in the process of moving forward, and it could improve affordability. But then we also have to ask, who are the people that would take advantage of this mortgage? And what would that look like, especially when you're signing a loan if you're 30 years old, and then you wouldn't end up paying it off until you're 80, which is a very long time. So in reality, a lot of these mortgages may not end up being held all the way till the end. Like I doubt there's going to be someone that gets one of these mortgages and really holds it for 50 years, because that would also imply that they stay in their home for 50 years. So even 30-year mortgages now, most people don't end up keeping them because they move. Or even if they stay put and interest rates drop dramatically, they could refinance. And so that they're basically tearing up the mortgage that they had and getting a new one. And that one could be another 30-year mortgage, or perhaps they get a 15-year or something. And so keep in mind that while it is a shocking thing that I've heard many people say that, well, everyone's going to be 80 still paying off their mortgage, even with this, that is not the case. That will not happen. Most people will not have these mortgages for 50 years. But we get into some of the benefits, and it says that there's a question about the mortgage rate. The average rate on a 15-year fixed mortgage is currently 66 basis points lower than the rate on a 30-year fixed, according to the Mortgage Bankers Association. This would imply that the rate on the 50-year fixed mortgage would be higher. It all depends, of course, on investor demand for the product. So they're taking two data points here for the rates on the 15-year mortgage, the rates on the 30-year mortgage, and then, just taking those two data points, trying to extrapolate that the interest rate would be higher on the 50-year. So not that that's the best guide to do that with, but keep in mind, another reason why the interest rate would be higher is also that it's a longer term loan, right? It's a longer term loan. It's for 50 years. So there's an increased risk for the bank because they're putting this money out and not expecting to get it back for a very long time. And like we said, most people probably won't have it all 50 years, but who knows? Maybe they do have it 35 years, right? There's some people that definitely do keep their 30-year mortgage and hold on to it. But there's with the 50-year mortgage, it could enable some people to get to the 35-year, 40-year mark. And that represents risk for a bank or for a mortgage lender, because that is a long time. Who you're lending to, their financial situation could change drastically over that time. Their jobs could change. Their family size could grow. Their expenses could increase, right? There's a lot of things. There's a lot of things that can happen. Sickness. So it represents a bigger risk, which therefore could mean higher interest rates to make it happen. Now, there is a precedence for higher term loans, and we could look to the corporate bond market as an example of this. So Disney, everyone knows Disney, they have actually issued corporate bonds that are for 100 years. I bet you didn't know that, for 100 years. And they're able to do that because they're such an enduring brand. They have tons of physical assets. They have tons of IP. Think about all the characters from all the movies and cartoons that they rely on, and that they can cross-market that through all their theme parks and all their merchandise. And then you have, the whole television side of the business. You have now the streaming side of the business. And keep in mind, the parks, they're not just in America. They have parks all over the world. So Disney is a very large operation. But keep in mind, when they're issuing a 100-year loan, a 100-year corporate bond, say they do that today, that means none, zero of the tens of thousands of people that currently are employed by Disney will be around when that bond matures. And in fact, it's unlikely that anyone they hire in the next 20 years, so say they issue the bond today, 20 years from now, everyone they hire in the next 20 years will also not be around when that bond matures. So that represents a bit of a risk, and some of those risks are similar to what we could see with the 50-year mortgage. Now, I said before that 30-year was the highest mortgage available now. Well, that also wasn't always the case. I believe it was in the 50s that was introduced. Before that, mortgages didn't even go to 30 years. And so why is this continually proposed as a solution? And the idea is, well, the payment could be less. And this article mentions that, and it gives a brief example. It says, use the latest median sale price of a home from September, which was $415,200, according to the National Association of Realtors, and the current interest rate of about 6.3%, according to Mortgage News Daily, on a 30-year fixed loan. With a 20% down payment, the monthly payment of just principal and interest, wait for it, this is the monthly payment, $2,056. If you raise the length to 50 years at the same interest rate, that payment would be $1,823, a savings of $233 per month. $233. Now, if you've been watching these videos, you know that I enjoy being frugal. I like finding a good savings, but $233 a month doesn't sound like something groundbreaking, right? And that goes for the people that are trying to get a home today, that desperately want a home, but they don't have enough of a down payment, or the interest rates are too high for them, and they want a home. Introducing this option, well, there you go. It's more affordable. It's $233 cheaper. I don't think that's going to make or break it for a lot of people. That might for some people, but I'd argue that if $233 a month is going to make or break the difference as to whether you can afford a home or not, then I'm going to go out on a limb and I'm going to say you should not be buying that home. You cannot afford the home if just $233 per month is going to throw off your ability to pay. And so thereby getting the 50-year mortgage, you can say, oh, well, now I can afford the home. Because if you have a home, and if you have for some reason an increase in expenses to the tune of about $233 a month, then that would mean that you're homeless. that if you're really dependent on that $233 to be able to make the mortgage payments, then you're really just cutting it too close. So, unfortunately, the math doesn't lie, and these mortgages don't all of a sudden drastically cut this typical estimated interest rate of or interest payment of $2,056 to $1,000. That would be sizable. That would be noticeable. But it's just, adding the extra 20 years, it's just not enough, because now you're also paying a substantial amount of interest, additional interest over that time. So, I wouldn't do it. I'm against most forms of debt. You all know this, and including mortgages. So I certainly wouldn't get a bigger mortgage, because I don't like mortgages to begin with. This is also interesting. It points out that the average age of a typical first home buyer in 1991 was 28 years old. By 2024, it had reached 38 years old. And this is a report from the National Association of Realtors. So housing affordability from almost 35 years ago obviously has gone down because the average age has gone up. And what can we say unequivocally about 38-year-olds as opposed to 28-year-olds? And that's 38-year-olds have more money. So they have an ability to buy homes. But then at the same time, there's shifting culture. People are getting married later also, and therefore that could then push down getting a home. So I think it's not just an affordability issue, but that. And at the end of the day, I think it's a Band-Aid, and it really doesn't address one of the key problems of why prices are so high, and that's a lack of inventory. Right? That's not something that's really being talked about here. It's a lack of inventory. You have people that want homes, and now granted, currently there's more homes for sale, substantially more. We're not like it was 4 years ago, when there was almost no homes and there was big long lines, right? There's now there are more homes for sale. So that's good because that helps with the inventory problem, but they're also not affordable. So you need more homes, but affordable homes. And it should come as no surprise that America has plenty of land. America has plenty of empty land to build homes, but many people don't want to live on that land. Many people want to live where they grew up, or they want to live in a major city, or they want to live in a nice suburb. And that does not work when you don't have the money to actually buy the homes. Unfortunately, you have to essentially trade down in city. You have to go find a cheaper city if you want a city life. You have to move into the Midwest is basically what I'm getting at, or into the South, or into that's the Southeast, or in lesser populated parts of the Southwest. That's what you realistically have to do if you want to get into a home and don't have the money to do it in a major market. And so you have to go where there's more affordable inventory. Many people probably aren't willing to do that. That's a tough thing to do, to uproot your life and go somewhere else just for a house. And I don't blame people for that, because at the end of the day, you may have the dream of a house, but houses come with plenty more expenses. And I won't get into the whole rent versus buy math, but many people do the math wrong because they don't take into account the upkeep that goes with the house and the property taxes. But so ultimately, I would not do this, even if you have a high income, because I can see the people with high income saying, well, why would I give all my income away immediately? If I can get a good enough rate, then I can, save my higher income and, well, not save it, but hold on to it and then invest it and then try and get more money. And over the long run, and I'll just sign up for the 50-year mortgage. Who cares? I've never been a fan of that approach. I don't like the extra paperwork in my life. I don't like the extra debt burden in my life. And so I would say, despite having a high income, I would avoid the 50-year mortgage. And after all, it's just it's a Band-Aid fix that I don't think will help very many people. So that's the news for today. 50-year mortgage. Go ahead, put in the comment section if you are on board for the 50-year mortgage. And in fact, if you want a 100-year mortgage, please like and subscribe. I would greatly appreciate it. Have a good night.